Hello, this is Connie Belden, and in this video we're going to go over variable overhead variances. Packaging of our bike helmets could be considered a manufacturing overhead item. So therefore, let's assume in this example we manufactured 1,800 bike helmets and we used 60 direct labor hours to package those helmets. The direct labor cost of the packaging was $186. The standard cost information indicates it should require 0.03 hours of direct labor per helmet to package it, and the variable overhead rate is $3 per direct labor hour. So like with the other variances, we're going to start with some sub-calculations. We're first of all going to calculate the standard hours allowed for packaging those 1,800 bike helmets. So we would take the actual helmets given at 1,800 times the standard direct labor hours per unit, which is given at 0.03. Multiply that out. That is a total of 54 standard direct labor hours. Okay, for question 2, calculate the standard variable overhead cost in total for those 1,800 units. So I would take the standard quantity that I came up with in part 1, which is 54 hours, times the standard rate is given at $3 per hour. Multiply that out. That is a total of $162 as my total standard variable overhead cost. So in part 3, we want to get the total variable overhead variance. And we can do that by taking the actual variable overhead cost given at $186 and subtract the total standard overhead cost, which we just calculated in part 2, was $162. And that gives us a positive $24 for our total variable overhead variance, and that is a positive, so that would be unfavorable. Okay, now that we have that information, we are going to go ahead and calculate the variable overhead rate variance and the variable overhead efficiency variance. First, we do need to calculate the actual rate per hour. And we could do that by, if we go up here, you'll see that the actual overhead cost for variable was $186, and that was for 60 direct labor hours. Okay, so if I take $186 and divide it by 60 direct labor hours, that gives me $3.10 per hour. Okay, now I will fill it into the formula, which is given right here. Okay, I will take the actual rate, which I just calculated at $3.10. Remember, the standard rate was given to you at $3 an hour. So I would subtract that first for 10 cents, and then take it times the actual hours, which was given to you at 60 direct labor hours. So when you take 10 cents times 60, that gives you a positive $6. And remember, a positive is unfavorable. Okay, for the variable overhead efficiency variance, that formula will be to take the actual hours, which were given to you at 60. If you go back to part 1, remember we calculated the standard hours is 54. And then we'll take it times the standard rate per hour, which is given to you at 3. Okay, so when we take 60 minus 54, that gives us a positive 6, times 3 gives us a positive 18. A positive number is unfavorable. So in this case, we have both unfavorable variances. Now, remember we got a total variance in part 3 of $24. So these are both positive. So when I add 6 plus 18, I did that down here, that also gives me the same answer I got in part 3, which is 24 unfavorable. Okay, for this last problem, problem 9, you'll be doing all the variances, materials, labor, and overhead. There won't be a separate video on that, but it's done similar to what we did in the previous problems. And the answer to this is available on the Excel file that has the answers to the other exercises from Chapter 10. Thank you very much.